Yesterday, the big software companies had a no good, terrible day in the market. Adobe was down about 5.5%. Autodesk was down about 2.6%. Salesforce down more than 7%, and Intuit down about 4.75%. And the fear is that AI is coming in and making the software companies obsolete. So what we're going to do is we're going to look at these four companies, both historically and into the future, to see if there's any possible buying opportunities given this crash. When we zoom out from yesterday and we look at these four companies against the S&P 500 over the past month, we see a massive outperformance. All four are down, the worst being Adobe, down 13%, compared to the S&P 500's up 2%. We're looking at VU, the Vanguard S&P ETF. We zoom out to the past 3 months, and we see the same sort of story. The S&P 500's up about 6.5%. Everybody else is down. CRM is basically flat in the past 3 months, but we can see Autodesk is down about 10.83%. And we have VU, the S&P 500, up 21%. Everybody else is down. Salesforce being the worst performer, and then right behind it, Adobe, Autodesk, and Intuit, all down over the past year. So let's get into their growth numbers. Let's look first at Adobe. Adobe's coming in with a PEG ratio of 1.0. Remember, we want PEG ratios to definitely be under 2. 1 and under means that it's a pretty decent bargain relative to their growth. Forward PE at just the 12.5, and a 5-year forward PE coming in at a 10.1. Return on equity and return on invested capital looking solid. Profit margins looking fantastic. Next is Autodesk. Return on equity, second place today at 40.3%. Return on invested capital, also second place, coming in at 19.6%. We have fantastic expected 5-year EPS growth at 23.7%. PEG ratio above 1, so not the most fantastic thing we see here. Salesforce, CRM, PEG ratio coming in second place at 1.2. Debt to equity phenomenal at 0.2. They have very low debt relative to their equity, so we like that because that indicates that they might be able to survive some sort of recession, some sort of hard times on the horizon. Free cash flow yield coming in at 5.7%. 5-year forward PE coming in at a 13.9. And finally, we see the numbers for Intuit. PEG ratio, not too fantastic at a 1.7. Very low debt to equity at a 0.4. Profit margins looking very healthy at 21%. EPS growth expected to be almost 20% every year for the next 5 years. And that would lead to a 16.9 5-year forward PE for this company. So if you're new to this channel, what we do is we look at these numbers and we rank and we score each company on a scale from -10 to +10. And so we see that the lowest scoring company for growth is Salesforce, coming in at a 4.5. Next is Autodesk, coming in at a 6 for growth. Intuit also coming in at a 6, tied for second place. And the top dog is Adobe, coming in at a score of 7. Next, we want to look at safety. We want to see how safe are these companies. Now, typically software, technology, these things, they're not reliable safety companies, but we do want to bake in a little bit of safety because these stocks, these companies have experienced such volatility. We want to make sure that they can survive some hard times. So first up is Adobe, coming in 18.6 PE currently, trailing 12-month PE. Return on invested capital and return on assets, phenomenal. Some of the highest that we see of these four companies. They don't pay a dividend, unfortunately, so that's going to penalize it for its safety score. But we do see free cash flow yield at 7.6. Typically, we want that to be 7% or higher, so that's a fantastic number there. Autodesk, return on invested capital coming in second place at 19.6. Not the greatest PE, 52.5, that's quite high. But if they can execute on the growth that they're expecting, that's going to come down to an 18.2 relative to 5 years from now. Now, Salesforce is the first company that we see that has any sort of dividend, just a 0.5% dividend yield. They've grown their dividends about 4% recently, and they've grown their dividends for 2 consecutive years. So PE ratio coming in at a 32, that's going to be second place for what we see today. And Intuit coming in with the highest dividend that we see in terms of yield at a 0.8%. They've grown their dividends recently 15.5%, and they've grown those dividends 15 consecutive years. So when we get to the safety scores, also from -10 to +10, we see Autodesk coming in at the lowest at 2.9, so not too fantastic. We see Salesforce coming in, even though it pays a dividend, it's coming in at a 4.3 in terms of safety relative to the others. we see that Intuit's coming in also at a 4.3. And once again, the top dog today is Adobe coming in at a 7.1, which is quite interesting because Adobe does not pay a dividend. The fact that their return on assets, their return on invested capital, their PE ratio, their 5-year forward PE ratio, their free cash flow yield, these things are all so fantastic relative to the other companies. They're coming in at the top of the list for safety. So as we've done many times on this channel, we want to make sure that not only are these companies scoring well, not only are these solid companies, but we want to make sure that we're getting a good value for our dollar. So we want to make sure that the intrinsic value of these companies is high relative to their current stock price. And so we're going to compute different intrinsic values. And there's links in the description of this video that show you step by step how to make your own intrinsic value calculators so you can build out these models yourselves, one of the most important tools in any investor's toolbox. We do a PE ratios model. We also show you how to do a dividend discount model. However, these companies do not offer a solid dividend, and so we're not going to do these. As you can see, margin of safety of 664%. These are not reliable models for anything that we're studying today. We do a discounted cash flow model, and we also do a Peter Lynch model that's based off of Peter Lynch's PEGI ratio. So if you want to see how to build out those models, there is a link in the description below to each of those tutorials. Now, what we do is we compute each model that's valid. So again, we're not going to do a dividend discount model for any of these companies, and we average them. What we've noticed is that the Peter Lynch model typically is the lowest. It's the most bearish of all of them. So what we're going to do is we're going to compute intrinsic values for these 4 companies with and without the Peter Lynch intrinsic value, just to see, does that valuation model really drag the price down? If so, does that give us more intrinsic value and make us a little bit more comfortable for buying these companies? So just a quick request, if you got anything out of this video, please consider liking this video. Please consider subscribing to the channel so you can keep receiving our content at Inner Flame Finance. So we'll just get right into it. So the lowest score was Salesforce at 4.4. They had growth at 4.5. They had safety at 4.3. So right off the bat, the fact that our average score is less than 5 gives us pause. We probably would not consider buying it yet. Intrinsically, we think that Salesforce is $230. It's currently trading for $241. That gives us a 4.8% premium on the stock price. So the stock is currently trading more than it's worth. If Salesforce drops to 196, we might consider buying it. If it drops down to 150, if this is a stock that we wanted, if their scores got higher, this is something that we would buy more heavily at 150 or lower. Autodesk also below 5 on average. It had a growth score of 6, which was nice, but it had a safety score of just 2.9. So on average, this company came in at a 4.45, also because they are trading for a 29% premium. They're currently trading for $271. Intrinsically, we think that they are worth $210. Intuit's coming in with the score above 5, so that's a good sign. However, it is trading for a 31% premium, currently trading for $605. We think intrinsically it's worth $461. We want to make sure that we buy it at a discount, however, so we would consider buying Intuit if we wanted in our portfolios at $392, and we would buy much more heavily if Intuit got down to $300 or lower. And finally, Adobe had the highest score. It had a growth above 5. It had safety above 5. Its average is above 5. Its current stock price is $310. We think intrinsically it's worth $284. That gives us a 9% premium on Adobe stock price. We would consider buying Adobe if the stock price fell to $241, and we would buy much more heavily at $185. If we take the Peter Lynch valuation model out, that certainly raises the intrinsic value for all 4 companies. As a matter of fact, Salesforce comes in at an intrinsic value of $285. Current stock price is $241. So that does give us a margin of safety of 15.4%. We would consider buying it if the score were higher, if it were 242 or lower, which it currently is, barely, and we would buy much more heavily at 185. However, the score does not currently justify a heavy buy into that company. Autodesk still trading at a premium. However, that premium has gone down quite a bit with the omission of the Peter Lynch valuation model. Intrinsically, 263, currently trading pretty close to that for 271. But again, score not coming in above 5, we probably would avoid it given the risk baked into these companies. Now, before we continue, I do want to point out that when I did my intrinsic value calculations, I did use a discount rate of 10%. Because of the fear of AI, because we don't know how AI is going to affect this sector and this industry, we want to bake in a little bit more caution. So rather than using a discount rate of 8%, we are using a discount rate of 10% for all 4 of these companies. First company that came in above 5 on average Still trading at a premium, but not as much. We would buy into it if it came down to 475. We would buy much more heavily at 363. And finally, Adobe, the margin of safety is 17.6. That's almost at our 20% threshold that we typically like to buy things. Intrinsically, we think Adobe is 376. It's currently trading for $310 per share. So we would consider buying Adobe if it came in under 320, which it just barely is. We would buy much more heavily if it comes in below 244. So that's it for the software companies that we studied today. If you got anything out of this video, please consider liking and subscribing to the channel. Remember, nothing that we say on this channel is financial advice. We're not telling you to buy, hold, or sell anything. Past performance in any of these companies does not indicate any sort of future gains. Always do your own research. Always do your own due diligence. We appreciate you being here, and we'll see you in the next video.